Today we are taking a closer look at a bold call from Tom Lee, Head of Research and Chief Investment Officer at Fundstrat Capital. In a recent interview on CNBC's Power Lunch, he shared why he believes the stock market may actually be forming a bottom this month, even as headlines remain filled with geopolitical tension, credit concerns, and volatility across financial markets. In this video, I will show you the clip from CNBC where Tom Lee and Cathie Wood discuss the current state of the equity markets, the private credit narrative, and why tech stocks are holding up better than many investors expected. After that, I will break down what Tom Lee said and explain what it could mean for the market going forward. Then we will dive into 3 of the best stocks to buy right now that could benefit if this market bottom thesis plays out. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Now let's hear what Tom Lee and Cathie Wood have to say.
Let's welcome in Cathie Wood, CEO and CIO of ARK Invest, and Tom Lee, Head of Research at Fundstrat, Chair of 𝗣𝗟𝗏 Immersion Technologies, and a CNBC contributor. Welcome to both of you. Tom, you want to just start with your thoughts on the markets? Why is tech kind of not participating this time? They've been a ballast so far in this sell-off.
Yeah, I mean, I think tech in general has actually held up really well, including software. It makes sense to us because, I'm going to make a counterintuitive statement. Higher oil is relatively good for U.S. equities because, one, the U.S. is a net producer of oil, but as people worry about global growth slowing because of high oil, they want to own growth stocks, which actually makes them want to own the U.S. stock market because it is a growth index, especially the Mag 7 and software. So I actually think that this kind of makes sense. And I've heard the earlier conversation today. I'm also in the camp that I think we're making our bottom this month for the equity markets.
Okay. What about, we got Jefferies down 7%, Deutsche down about that much. A lot of people are trying to look around, poke into where these private credit exposures and stuff might be. What would you say about that narrative right now, Tom?
Well, private credit's been a problem for some time. So I think it has been increasingly revealing, as Jamie Dimon said, more cockroaches. I do think it's probably not as systematic as we might fear. I know people carry the Lehman hammer and think that this is a repeat of the GFC. But again, there's a lot of reasons it's not a systematic one. It's just the size of the market's not nearly as large. But also, things that look like credit stress aren't really signaling like they did in 2008. So I think it's hurting financials right now, but I don't think it's a broader problem for the market or the economy.
Cathie, you guys are looking, if I'm not mistaken, to kind of help the public get into more early stage growth companies. And we saw last week Robinhood did something similar. They're IPOing a venture fund. And this comes against this backdrop where a lot of the kind of growthy companies have ended up in private markets and they don't go public anymore. Then I know the SEC has a big push to try to change that. But one of the problems, as you and others know, is that sometimes they don't perform that well. It's very risky. So could you just comment on the current state of affairs? Like the private markets have losses. You go in the public markets. People don't want losses, but they want access to growthy companies. Who can they feel confident will help give them the best of the bunch?
Yes, Kelly. Well, it's very interesting to be managing money at this time and to have managed money, very early portfolio manager, early in my years, in the tech and telecom bubble. It's night and day. There was no fear back then. And today, there's extreme fear. And there are some reasons, understand that. But I believe, and this is going to fit into what Tom just said, I believe the market, when we look back, maybe at the end of this year, is going to be characterized as climbing a wall of worry. And of course, now with the war, there is another reason. There are another few bricks being put into that wall. This is a really good time to pick up on stocks that might be more volatile. Volatility in our world it does not measure risk as much as it measures uncertainty. And I think the new technology is evolving today, and the way we do, ARC does its research on these technologies to understand how they're going to scale and who's leading the pack. I think we're in a very good position. And the opportunities, this is a technology revolution. And we are not in an AI hype cycle. And we think it has miles to go. And of course, consider the source. It's all we do. But we're beginning to see results, astounding results at companies like Anthropic and OpenAI in terms of their ARRs.
One of the first points Tom Lee makes is about technology stocks and how they have behaved during this recent market stress. Normally, when markets sell off because of geopolitical tension or macro uncertainty, high-growth stocks tend to fall harder. But that is not exactly what we are seeing this time. He points out that tech, including software companies, has actually held up relatively well. That is a very important observation, because when markets experience stress, the leadership behavior tells you a lot about what investors actually believe. If investors thought a deep recession was coming, you would expect growth stocks to collapse first. Instead, many of them are acting like a stabilizing force. Tom Lee makes a statement that might sound counterintuitive at first. He says higher oil prices can actually be relatively good for U.S. equities. At first glance, that seems strange. Most people think rising oil prices are automatically bad for the economy and the stock market. But his reasoning is interesting. The United States today is a net producer of oil. That means higher energy prices can actually benefit parts of the U.S. economy. At the same time, when investors worry about global growth slowing because of higher energy costs, they tend to rotate toward companies that can still grow regardless of the macro environment. And that is where growth stocks come in. According to Tom Lee, the U.S. stock market is fundamentally a growth market. When investors want exposure to companies that can still grow earnings even in uncertain conditions, they often end up buying the large technology leaders and software companies that dominate the index. Personally, I think there is a lot of truth in that argument. If you look at the structure of the U.S. market today, it is very different from decades ago. Technology companies drive a huge portion of earnings growth and innovation. Investors searching for growth tend to gravitate toward those names almost automatically. Tom Lee also mentions something very important about timing. He believes the equity market may actually be forming a bottom during this month. Now, that does not mean he is saying the market will immediately go straight up, but it suggests that the worst of the selling pressure may already be behind us. This idea of a market bottom forming is something investors always struggle with, because the market rarely rings a bell when the bottom happens. Instead, bottoms usually occur when fear is still very high and headlines still look negative. That is exactly the environment we seem to be in right now. When geopolitical conflicts dominate the news cycle, many investors assume markets will keep falling, but markets are forward-looking. If stocks are already pricing in the risk, they can stabilize even while headlines remain scary. Now, the conversation in the interview also shifts toward private credit, which has become a growing concern on Wall Street. Private credit has expanded dramatically over the last decade. Instead of banks lending directly to companies, a large amount of lending now happens through private funds and non-bank institutions. Some investors worry that if those loans start to fail, it could create broader financial stress. The interviewer brings up declining financial stocks and questions about exposure in the private credit market. Tom Lee acknowledges that private credit has been an issue and that problems are slowly being revealed. He even references Jamie Dimon's comment about more cockroaches appearing. What that means in financial language is that when stress appears in a credit market, it often reveals additional problems that were hidden before. But Tom Lee believes the situation is not nearly as dangerous as some investors fear. He specifically compares the current environment to the financial crisis in 2008. That comparison is important because many investors instinctively assume that any credit stress could trigger another systemic collapse. But Tom Lee argues that the structure of today's credit markets is different. The private credit market is not as large as the mortgage market was before the financial crisis. More importantly, he says the signals we normally see during systemic stress are not appearing. During the financial crisis, credit markets were freezing, spreads were exploding, and liquidity was disappearing. Those are the types of warning signals that indicate systemic risk. According to Tom Lee, we are not seeing those signals right now. Instead, the pressure seems more contained within financial stocks rather than spreading across the entire economy. Personally, I think that is a critical distinction investors should understand. Financial stress can exist without triggering a full-scale crisis. Markets can digest localized problems without collapsing entirely. But the interview does not only focus on risks, it also touches on opportunity. Cathie Wood joins the conversation and talks about investing in early-stage technology companies and giving public investors access to growth opportunities that are often locked inside private markets. One of the major shifts in the investment landscape over the last 20 years is that many high-growth companies stay private much longer than they used to. That means public investors sometimes miss the early stages of their growth. This creates a challenge. Investors want access to innovative companies, but those companies are often still in private funding rounds, and when they eventually go public, the valuations can already be very high. Cathie Wood brings an interesting perspective to this issue. She says the current market environment is characterized by extreme fear, and she compares that to the tech bubble era when she was managing money earlier in her career. Back then, she says there was almost no fear at all. Investors were extremely confident and speculative. Today, the situation appears almost opposite. There is widespread anxiety about economic growth, geopolitical conflict, inflation, and market stability. She believes that fear is actually creating opportunity. She uses the classic phrase that markets climb a wall of worry. What that means is that bull markets often advance while investors remain skeptical and cautious. Every new concern becomes another brick in that wall of worry. Right now, those bricks include war, interest rates, geopolitical tension, and credit concerns. But Cathie Wood believes the technology revolution happening today is very real and still in its early stages. She makes a very strong statement that we are not simply in an artificial intelligence hype cycle. Instead, she believes AI represents a fundamental technological shift that still has a long runway ahead. Now, this is where my own perspective comes into play. I do think artificial intelligence is transforming industries in a meaningful way, but I also think investors need to separate real technological progress from speculative enthusiasm. The long-term potential of AI is enormous, but markets can still overshoot in the short term. We have seen that happen with many emerging technologies throughout history. However, the bigger point she is making is that volatility does not always equal risk. She says volatility often represents uncertainty rather than permanent damage. That distinction is extremely important. Many investors see volatile stocks and assume they are risky, but sometimes volatility simply reflects the market trying to understand a new technology or a rapidly evolving industry. In those moments, long-term investors who understand the underlying innovation may find attractive opportunities. Tom Lee's comments about market behavior actually connect well with Cathie Wood's perspective. Both of them are essentially saying the same thing in different ways. Markets are full of fear right now, but that fear might be setting the stage for opportunity. If technology leadership remains strong, if credit stress remains contained, and if geopolitical shocks do not escalate dramatically, the market could stabilize sooner than many investors expect. And that is really the key takeaway from this interview. Even when the news looks negative, markets can start forming a bottom if investors begin to believe that the worst-case scenarios are unlikely. In my view, the biggest mistake investors make during periods like this is reacting emotionally to headlines instead of analyzing underlying trends. Tom Lee is focused on market behavior, leadership, and structural factors. Cathie Wood is focused on innovation, technological disruption, and long-term opportunity. When you combine those perspectives, you get a picture of a market that is nervous but not collapsing, a market that is volatile but still supported by growth sectors, and possibly a market that is quietly preparing for the next phase higher. Of course, none of this guarantees that the bottom is already in place. Markets rarely move in straight lines. There will always be new headlines and new uncertainties. But what Tom Lee is suggesting is that the conditions for a bottom are beginning to appear. And if that is true, the next phase of this market cycle could create some very interesting opportunities for investors who are paying attention. Now, let's dive in and talk about the 3 best stocks to buy right now that could benefit when the market bottoms out. Let us start with the first company, Shopify, ticker symbol SHOP. Shopify has quietly become one of the most important infrastructure companies in global commerce. When people think about e-commerce, they often focus on marketplaces, but Shopify operates on a completely different level. Instead of being the store, Shopify provides the entire operating system that powers online businesses. Millions of merchants around the world rely on Shopify to run their storefronts, process payments, manage inventory, handle shipping logistics, and connect to customers through multiple sales channels. That includes websites, mobile apps, social media platforms, and even physical retail locations. The reason Shopify matters long-term is because entrepreneurship itself is growing. Every year, more individuals and small businesses launch digital storefronts. The barriers to starting a business online are lower than ever, and Shopify sits directly in the middle of that trend. One of the most powerful aspects of Shopify's business model is its ecosystem. Shopify does not simply provide a website builder, it provides an entire commerce infrastructure platform that integrates payments, marketing tools, fulfillment services, and a large network of third-party applications. This ecosystem creates switching costs. When a merchant builds their business on Shopify, they are not just using one product, they are using a suite of integrated services. Migrating away from that infrastructure can be complicated and expensive. That stickiness is one of the biggest competitive advantages Shopify has built. From a financial perspective, Shopify has continued to demonstrate strong revenue growth driven by merchant adoption and increased transaction volume. Its revenue comes from two primary streams: subscription solutions and merchant solutions. Subscription solutions include the monthly fees merchants pay to access Shopify's platform. Merchant solutions generate revenue from payments processing, shipping services, financing tools, and other value-added services. What is important about this model is that it scales with merchant success. As Shopify merchants grow their businesses and process more sales, Shopify captures a larger share of that economic activity through merchant solutions. In other words, Shopify grows alongside the entrepreneurs who use its platform. Another major growth driver for Shopify is the continued expansion of global e-commerce. Even though online shopping has grown rapidly over the last decade, e-commerce still represents only a portion of total retail sales globally. As more commerce shifts online, platforms like Shopify are positioned to benefit. But Shopify is not just focused on small merchants anymore. Over the past several years, the company has been expanding into the enterprise segment through Shopify Plus. This allows larger brands and established retailers to build customized commerce experiences while still using Shopify's underlying infrastructure. Enterprise adoption increases average revenue per customer and strengthens the company's competitive positioning. Now let me give you my personal perspective. Shopify is one of those companies that has evolved from a simple software provider into a foundational layer of modern commerce. When you think about where the world is heading over the next 10 years, entrepreneurship, digital retail, and direct-to-consumer brands are only becoming more important. However, Shopify has also experienced volatility because high-growth technology stocks tend to react strongly to changes in interest rates and macro sentiment. That means investors need patience. If you believe in the long-term shift toward independent digital commerce, Shopify's platform advantage could continue strengthening over time. Another interesting angle is Shopify's focus on empowering merchants rather than competing with them. Many entrepreneurs prefer owning their customer relationships instead of selling exclusively through marketplaces. Shopify gives them the tools to do that. That philosophy has helped Shopify build strong loyalty among merchants. When evaluating long-term investments, it is always important to ask one question: is this company becoming more relevant or less relevant over time? In Shopify's case, the digital commerce infrastructure it provides is becoming more critical, not less. And that is exactly the type of business that can compound for years. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us move to the second company, Chewy, ticker symbol CHWY. Chewy operates in a completely different industry, but its long-term potential is just as compelling. The pet industry has become one of the most resilient consumer sectors in the economy. Pet ownership has grown significantly over the past decade, and spending per pet continues to increase as owners treat their animals like members of the family. That emotional connection creates powerful customer loyalty. Chewy has positioned itself as the go-to online destination for pet products, offering everything from food and treats to medications and veterinary services. But Chewy's real strength is not just its product selection, it is its customer experience. The company has built a reputation for exceptional customer service, fast delivery, and a highly personalized shopping experience. That level of service helps build long-term relationships with pet owners. Another key component of Chewy's strategy is its auto-ship program. Auto-ship allows customers to schedule recurring deliveries of pet food and supplies. This creates predictable recurring revenue and encourages long-term customer retention. Recurring revenue is extremely valuable in retail because it reduces volatility and increases lifetime customer value. Financially, Chewy has demonstrated steady revenue growth supported by strong active customer numbers and increasing spending per customer. Pet owners rarely cut spending on their animals, even during economic downturns. That resilience makes the pet industry attractive from an investment perspective. Chewy has also expanded into higher-margin categories like pet healthcare and prescription medications. Healthcare is one of the fastest-growing segments within the pet industry. As veterinary care becomes more advanced, pet owners are spending more on treatments, diagnostics, and preventative care. By integrating pharmacy services and healthcare offerings into its platform, Chewy can capture a larger share of total pet spending. From my perspective, Chewy's long-term opportunity lies in building a comprehensive pet care ecosystem. If the company continues expanding into services like telehealth consultations, insurance offerings, and wellness programs, it could evolve from a retailer into a full-service platform for pet owners. That type of transformation significantly expands the total addressable market, and more importantly, it deepens customer relationships. Pet ownership has evolved dramatically over the past 2 decades. For many households, pets are not just animals. They are companions, family members, and in many cases, emotional anchors in people's daily lives. That shift in consumer psychology has transformed the economics of the pet industry. When spending is tied to emotional attachment rather than simple consumption, demand tends to be extremely resilient. Pet owners will cut back on other discretionary purchases before they cut back on food, medicine, or care for their pets. That dynamic creates stability in revenue streams even during uncertain economic environments. Chewy has built its brand around this exact relationship between pet owners and their animals. The company is not simply an online retailer. It positions itself as a trusted partner in caring for pets. That philosophy shows up in the way Chewy handles customer interactions, shipping logistics, and product selection. For example, the company is well known for sending handwritten notes, sympathy cards when pets pass away, and providing fast customer support when owners need help. Those gestures may sound small, but they reinforce the emotional bond between the brand and its customers. That emotional loyalty translates directly into retention and repeat purchasing behavior. One of the most important drivers of Chewy's business model is the AutoShip subscription program. AutoShip allows customers to set up recurring deliveries of pet food, litter, medications, and other supplies on a scheduled basis. Once a customer enrolls in AutoShip, Chewy essentially becomes part of the household routine. That recurring order structure gives the company predictable revenue visibility. It also increases customer lifetime value because once a customer relies on automatic deliveries, they are less likely to shop around with competitors. Another powerful factor in Chewy's long-term outlook is the growing sophistication of the pet care industry. Veterinary medicine has advanced significantly. Diagnostic testing, preventative treatments, specialized diets, and advanced medications are becoming increasingly common. Chewy has been expanding into pet healthcare through its pharmacy services and prescription offerings. This is a strategic move because healthcare products typically carry higher margins than basic pet supplies. More importantly, they create deeper integration into the pet owner's care routine. Imagine a future where Chewy provides not only food and toys, but also prescription medications, telehealth consultations with veterinarians, wellness monitoring tools, and personalized nutrition plans. If the company successfully builds that type of integrated ecosystem, its role in the pet care market could expand dramatically. Financially, Chewy has shown steady revenue growth supported by both customer expansion and increased spending per user. Active customer numbers remain strong, and average revenue per customer has continued to rise as the company introduces new product categories. Another factor worth highlighting is Chewy's logistics network. Fast and reliable delivery is critical for e-commerce businesses. Chewy has invested heavily in distribution centers and fulfillment infrastructure designed specifically for the types of products it sells. Pet food bags, litter containers, and other bulky items require specialized logistics capabilities. Chewy's distribution network allows it to deliver these products quickly and efficiently, which strengthens customer satisfaction. From my perspective, Chewy represents an example of a company that could compound steadily, rather than explosively. It may not deliver the same type of hyper-growth that early-stage technology companies sometimes produce, but its consistent demand profile and recurring revenue model create long-term stability. Investors often overlook businesses like this because they appear less exciting than emerging technologies. But over a decade, companies with loyal customers and predictable revenue streams can produce impressive shareholder returns. Another point that deserves attention is demographic trends. Pet ownership has increased among younger generations, including millennials and Gen Z households. These groups tend to treat pets as integral parts of their lifestyle. As these generations move into their prime earning years, spending on pet care is likely to increase even further. That demographic shift provides an additional long-term growth tailwind for Chewy. Now let us transition to the third company on this list, Remitly Global, ticker symbol RELY. Remitly operates in one of the most important but often overlooked segments of the global financial system, cross-border remittances. Every year, millions of people working abroad send money back to their families in their home countries. These remittances represent a lifeline for households across emerging markets. According to international financial institutions, the global remittance market processes hundreds of billions of dollars annually. Traditionally, sending money internationally has been slow, expensive, and complicated. Legacy financial institutions and traditional money transfer services often charge high fees and require recipients to navigate complex processes to access funds. Remitly was built to solve this problem. The company provides a digital platform that allows customers to send money internationally quickly and securely through a mobile app. Transactions can often be completed within minutes, and recipients can receive funds directly into bank accounts, mobile wallets, or cash pickup locations depending on the region. The core value proposition is convenience and transparency. Customers know exactly how much money will arrive, how long the transfer will take, and what fees they are paying. That transparency builds trust, which is essential in financial services. Remitly's growth has been driven by increasing adoption of digital financial platforms among immigrant communities. As smartphones become more accessible globally, more customers prefer mobile-based remittance services instead of visiting physical transfer locations. This digital shift creates enormous opportunities for companies that can deliver fast, reliable cross-border payments. Another important aspect of Remitly's business model is geographic expansion. The company continuously adds new sending and receiving corridors between countries. Each new corridor expands its total addressable market. For example, a worker in the United States sending money to family in Latin America, Southeast Asia, or Africa can use Remitly's platform to transfer funds instantly. As global migration patterns evolve, the demand for cross-border money movement continues to increase. Financially, Remitly has delivered strong revenue growth supported by increasing active customer accounts and higher transaction volumes. The company benefits from network effects as more senders and receivers join the platform. Another long-term opportunity lies in expanding beyond remittances into broader financial services. Once a company builds trust with customers around money transfers, it can introduce additional services such as digital banking tools, bill payments, savings products, and even lending solutions. If Remitly successfully expands into these adjacent financial services, its growth potential could increase significantly. From my perspective, the most compelling aspect of Remitly's story is its role in financial inclusion. Millions of people around the world lack access to traditional banking services. Digital platforms that simplify financial transactions can help bridge that gap. In many cases, remittances represent the first step toward broader digital financial adoption. Once customers begin using mobile transfers, they become more comfortable using other financial tools within the same ecosystem. That progression could transform Remitly from a remittance platform into a broader financial services provider over time. However, investors should also recognize that financial technology companies face regulatory oversight and competition from other payment providers. Maintaining trust, compliance, and operational reliability will remain critical as the company scales. Still, when you look at the structural trends supporting Remitly's growth, the opportunity becomes clear. Global migration continues. Digital payment adoption continues. Mobile financial platforms continue expanding. And remittances remain a crucial economic force for families around the world. Now that we have walked through each of the three companies individually, let us step back and connect the bigger picture. When investors search for the best stocks to buy right now, they often focus too heavily on short-term catalysts. They look for the next earnings surprise, the next product launch, or the next headline that might push a stock higher in the near term. But the most powerful wealth-building investments usually come from identifying companies that sit at the center of long-term structural trends. That is exactly what makes Shopify, ticker symbol SHOP, Chewy, ticker symbol CHWI, and Remitly Global, ticker symbol RELY, so interesting. Each of these companies benefits from a trend that is not likely to reverse over the next decade. Shopify is tied directly to the continued expansion of digital commerce and entrepreneurship. Chewy is positioned within the rapidly growing pet care economy, which is driven by strong emotional spending behavior and demographic trends. Remitly is riding the global shift toward digital financial services and the continued growth of international remittances. These are not temporary themes. They represent fundamental shifts in how people shop, care for their pets, and move money around the world. Let us look first at Shopify again through a long-term lens. Over the past decade, commerce has been transforming at an incredible pace. Traditional retail channels have been gradually replaced by digital storefronts, social commerce platforms, and direct-to-consumer brands. Shopify provides the infrastructure that makes that possible. What makes this business model powerful is that Shopify does not need to predict which merchants will succeed. Instead, it provides the tools that allow thousands of entrepreneurs to build businesses. As those businesses grow, Shopify benefits from the increasing volume of transactions flowing through its platform. In other words, Shopify captures value from the entire ecosystem of merchants rather than relying on a single product or brand. That diversification reduces risk while preserving growth potential. Now let us turn back to Chewy. If Shopify is a platform business built around entrepreneurship, Chewy is a platform business built around customer relationships. One of the most remarkable things about Chewy is how it has managed to combine e-commerce convenience with genuine emotional connection to its customer base. Many retailers compete primarily on price. Chewy competes on trust and reliability. Pet owners depend on consistent deliveries of food, medications, and supplies. Missing an order or experiencing delays can create serious inconvenience. Chewy's logistics network and customer support infrastructure are designed to prevent those problems. Autoship subscriptions reinforce that reliability. Now let us revisit Remitly. Remitly's opportunity comes from a completely different direction, but it is just as compelling. Global migration is one of the defining forces of the modern economy. Millions of people live and work outside their home countries, sending money to family members who rely on those funds for everyday living expenses. For decades, transferring money internationally has been inefficient and expensive. Remitly's digital platform simplifies the entire process. By allowing customers to send money through a mobile app and delivering funds quickly to recipients, the company removes many of the friction points associated with traditional remittance services. But the long-term opportunity goes beyond simple transfers. Once customers trust a digital platform with financial transactions, that platform can begin offering additional services. Remitly could expand into digital wallets, bill payments, savings products, and other financial tools that help users manage money more effectively. Now let us compare the three businesses from a portfolio perspective. Shopify offers exposure to global commerce infrastructure and entrepreneurship. Chewy offers exposure to a resilient consumer category with strong emotional demand. Remitly offers exposure to the rapidly expanding digital payments and financial services market. Together, these companies represent three different but complementary growth themes: commerce, consumer loyalty, financial technology. Diversifying across multiple growth drivers can be a powerful strategy for long-term investors. Because even if one sector experiences temporary headwinds, the others may continue growing. Of course, it is important to acknowledge the risks associated with each business. Shopify operates in a competitive technology environment where innovation and product development must continue at a rapid pace. If competitors develop superior commerce platforms, Shopify could face pressure. Chewy must maintain high levels of customer satisfaction while managing the costs associated with logistics and inventory. Operational efficiency will remain critical as the company expands its product offerings. Remitly operates within a heavily regulated financial services environment. Compliance, security, and regulatory approvals will remain central to the company's growth strategy. Understanding these risks is part of responsible investing. But when evaluating long-term opportunities, investors must weigh those risks against the structural advantages each company possesses. Shopify's ecosystem of merchants and services, Chewy's loyal customer base and recurring revenue model, Remitly's expanding global payments network. Each of these advantages can support sustained growth over time. Now let us zoom out one final time. The most successful investors are not those who chase short-term market trends. They are the ones who identify companies with durable business models and allow those companies to compound value over years. The key is patience. Growth stocks can experience periods of volatility. Earnings expectations shift, macroeconomic conditions change, and market sentiment fluctuates. But if the underlying business continues expanding its market position, long-term shareholders can benefit enormously. Shopify continues enabling entrepreneurs across the globe. Chewy continues strengthening its bond with pet owners. Remitly continues simplifying the movement of money across borders. Those are powerful foundations for long-term growth. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these companies do you believe has the strongest long-term advantage? Do you think Shopify's global commerce platform has the biggest runway? Do you believe Chewy's customer loyalty model will create the most consistent growth? Or do you think Remitly's financial technology platform could disrupt international money transfers on a massive scale? Leave your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.